Whilst clearing my desk recently of the associated bits and pieces one collects during lockdown, in anticipation of a new lockdown here in Victoria, I came across an old paper that I had read and marked up, but not actually done anything with or commented on. What intrigued me about this paper, as opposed to all the other bits and pieces I tend to collect, will become apparent when we look at the citation details of the paper. The paper itself goes by this very, very simple title of Can Stock Market Forecasters Forecast? And it looks like any other sort of paper you would find from a financial journal. But the interesting part about this paper does not become apparent until you actually begin to look at the paper itself, because you miss the actual detail in this header page. And I've marked up here the point that I consider to be important regarding this paper, and it is simply the date. So almost 90 years ago, people were asking the question, can stock market forecasters forecast? And this is a question that continues to be asked over and over again. But here's a spoiler alert for you. The answer is no. But the reason this paper was of such interest to me was because of the amount of work they had gone to, and that'll become apparent in a second. Remember, they did this all before computers. There was no doing a data dump into Excel, pushing a button, having written a little bit of code, and having results spat out for you. Somebody sat down and went through all this material, and they went through it by hand. And what is interesting about this is the timing. The Dow Jones Index itself had only come into being under 40 years beforehand. And so a lot of what is being asked in this paper is reasonably new. They don't have the depth of data and depth of history that we have available to us now. But it was still a question that somebody sought to ask and answer. And in doing so, they had two main groups. The first group were comprised of what you would call, let's say, professional investors, what we would call fund managers / hedge fund managers now. And this consisted of 20 fire and insurance companies. Fire and insurance companies is an old term, and these groups date back effectively to the Great Fire of London several hundred years earlier. The second subset of this were financial services groups. These are what they would consider to be, back then, a more modern form of investment. The second group were 25 financial publications, newsletter pundits, people who wrote bits and pieces in newspapers. And their data for them began in 1928. So they had roughly 5 years of data to actually work their way through. When looking at this paper, it does have the title as to whether stock market forecasters can forecast. But they were actually looking for something else. They were looking to see whether hidden within the data was any form of new, but let's call it an economic law, some form of mechanism that could point to patterns within the market itself. So they actually had a fairly rigorous academic approach to this. They were looking for something. What needs to be remembered, though, is that this occurred several decades before Eugene Fama came up with the notion of the efficient market hypothesis in 1970. So you could posit that in many ways they were looking for something that Fama actually found several decades later. So when we begin to look at the data itself, when we look at the financial services group, and this is where you get some sense of the amount of work that was put into this. They went through 7,500 recommendations and had 75,000 separate data entries into a ledger. This is something someone had done by hand. So what they did was match buy and sell recommendations, build portfolios that matched the buy and sell recommendations, and then corrected these portfolios for dividend splits and any other corporate action. So it's an extraordinarily laborious activity. What they found was as to be expected. Only 6 of this group of 16 had any success at all. When you get this sort of result, one of the first questions you ask is the result a function of chance, or is it a function of skill? Because whenever you look at records for anyone, what you're attempting to do is to ascertain whether they deliver skill. Technically, within the field of funds management, this notion of skill is known as alpha. So, for example, if the All Ordinaries returns 10% and my fund returns 12%, that differential is referred to as alpha. It's referred to or known as sort of a skill metric. And anyone who follows this sort of thing will know that very, very few fund managers deliver skill in any way, shape or form. And this is what this particular group found. They found that these results were no better than chance. When they moved to the fire insurance group, now the fire insurance group, as I said, is a more established group, a more sort of experienced group of investors and professionals. They, strangely enough, found exactly the same thing. They found that their results were no better than chance either. Financial publications proved to be very interesting, but interesting in the way they present the data, because they generated what you would consider to be perhaps one of the earliest sort of financial infographics that you would find in any sort of paper. What they did was they looked at these professional agencies, and you'll notice there's 24 as opposed to 25, which was noted in the study. This has occurred because one group had to be dropped out because of an incompleteness of record. They then built the same mechanisms and portfolios randomly. And they found something very, very interesting. When you look at these two side by side in terms of their records, at a cursory glance, they look almost identical, and they are almost identical. But pay closer attention to the twist, and that is that transition from positive to negative. You'll notice that the downside performance of the random records was better than the professionals. And this is something that persists. What is interesting about this sort of material is not only the insight into the history of markets that is deep and rich, and as I constantly bang on about, yes, I know most people think the market began yesterday when they started to look at it. No, it didn't. If you are serious about trading in any way, shape or form, it is incumbent upon you to understand the history of markets. For example, at present, everyone is talking about Bitcoin again. Bitcoin is the current version of the South Sea bubble or the Dutch tulip boom. And at present, one Bitcoin would buy you half a tulip at the height of the tulip boom. And so we tend to repeat these things over and over again. This is some later data from several decades later. And what it looks at is the forecasting record of mutual funds. So the technology has moved on a little bit. The market has become more experienced and sophisticated. And this asks the question, it says, right, how do we tell when funds are bullish or bearish? And the answer is quite simple. When a fund is bearish, it goes into cash. When it's bullish, it moves to be fully invested. What this data did was it looked at that pivot shift from bullish to bearish, and it then looked at the market's response a year later. So it used that shift as a form of prediction. And you can see from this the timing of mutual funds, i.e. their forecasting ability, is woeful. Because what I've done here is highlighted the times when the market was positive after their shift in blue. And again, we could attribute this to chance. And so this notion of forecasting and professionals' ability to forecast is a persistent theme within finance, and it's a persistent theme within the notion of academic finance. To my mind, the question's been answered. Professional forecasters cannot forecast. The late John Borman used to produce this wonderful thing called his Guru Index. And what he would do is he would look at the S&P 500 and he would annotate it with these wonderful little snippets from people making forecasts about what was to come. And in particular, the issue here is the timing since the GFC, with people talking about the potential for a crash, the fact that the market's topped, that the world is ending, blah, 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 the usual things you hear. And anyone who follows the market would know that they're all wrong. But this does raise a perhaps deeper, more philosophical question. And that is the question as don't, as traders, we all forecast in some way, shape or form? And I would respond with the notion that the answer is more nuanced than that, in that there's a difference in tone, intent and psychology. And this was in part prompted by a discussion I had on LinkedIn in responding to someone. Whenever you assign a value to something, whenever you prescribe that something should have a value, you're making a forecast that has your ego involved. This applies traditionally to investors who follow a fundamental approach. And as you would imagine, all the investors involved in this little experiment and in all subsequent ones are fundamental investors. They ascribe a value to things. So they have an emotional attachment and an intellectual attachment to the value they have ascribed to something. Traders, I believe, do something different. And the difference is given away in the name of our position sizing. Position sizing was originally called bet sizing. And it was called bet sizing because traders recognized that they were not making a forecast, rather a bet. And that bet was in part based upon their perception of their own edge. But the mere fact that it was sized, that is, the position did not occupy their entire portfolio, was a reflection of their own uncertainty as to what they were doing. And this, I think, is the central difference. People who forecast in the manner that we traditionally expect from financial pundits and the like have no uncertainty. They have no doubt. They are full of hubris. They are full of ego. Traders are the reverse. Traders should be full of doubt. The moment you put a position on, you should be thinking of all the things that could possibly go wrong and how you can act defensively to deal with those eventualities as they occur. And so we come back to the notion that we are simply making a bet, because the logical extension of a forecast particularly one that you are certain of, is that you would put all your resources into it. And unfortunately, this is what many traders, both amateur and professional, do. They make concentration bets because their ego is so invested in the process of them being right and their forecast about the future being right that they lose all sight of uncertainty, and they lose all sight of potentially variant perceptions. And the most important variant perception we have is that of the market. Because at the end of the day, the only forecast or bet that is ever correct is that of the market itself and not of the trader.